Hi, everybody. Today on Friends Talk Money, we're asking you a really important question. What's in your 401k? You know that commercial that says, "What's in your wallet?" Well, this is much more important than that. As millions of boomers and Gen Xers approach retirement, think about it. Their 401k is often their biggest liquid asset. But the reality is, a lot of people working so hard to be able to contribute to those plans and get to retirement, they don't actually know what's inside those accounts or how exposed they may be. So today we're going to cut through the assumptions and we're going to help you take control now rather than waiting until the day you stop working to figure it all out. But before we bring in our special guest today, I want to hear from both Richard and Terry. When you guys talk to people who are just a year or two away from retiring, do you get the sense that they really understand what's inside their 401k, or do you think that most people are just kind of hoping that it's all going to be working out behind the scenes? Richard?
I'd say probably more hoping than anything. I think they feel like they've made their choices years ago. They look at their statements every now and then to see how they're doing overall, but they really couldn't tell you what they're invested in.
Yeah, it's there's a big focus on the bottom line because forget even the recent volatility. We've had an incredible bull market since the early 80s when most 401k plans were created. The law enabling them started in the early 80s. Many people have now been contributing automatically for 25, 35 years before retirement. So the big focus is what's the number? What's that number? I talk to people and I say, "Oh, that's great. What do you own in your 401k plan?" "Oh, I own some funds." Well, what funds? Can you name some of them? Now, of course, some are proprietary that were created for those accounts, but most people can't tell me, well, they're all stock funds or it's all in an S&P 500. They don't know. It's stocks.
You know, and
But
and there's and that goes hand in hand with there's a statistic that's fairly new. According to Think Advisor, 62% of pre-retirees are saying that they're not confident that their savings are enough to last them forever. And so that means that that's more than half of pre-retirees struggling with uncertainty. It doesn't mean they're not going to be able to retire well, but they're uncertain. Yet again, the whole point of doing this show today is the fact that we're throwing a spotlight on really understanding what's inside their 401k in order to make adjustments now ahead of time.
yeah, the operable word here is risk. And the risks that might have been suitable for you when you were in your 30s or 40s, because, over the long run, there's never been a 20-year losing period, even with dividends reinvested, even adjusted for inflation in the S&P 500. So that was appropriate in your 30s, your 40s, your 50s. But as you get closer to retirement, this is it, boy. It's a river flowing through it while you're contributing. But when you get to the end of the time where you're contributing, now it's your swimming pool. And if the water level goes down, it's a very scary emotional feeling. And I really wanted to do this show today because I want to bring in a very special guest, a man who's been talking about the fact that it's okay to have these diverse investments in your plan while you're investing.
Hi, everybody.
Welcome. Now let me
Hello.
explain. Let me explain to everybody why Ron Surz is such a well-known name in the industry. He's president of something called Target Date Solutions. He's the author of Baby Boomer Investing in the Perilous Decade of the 2020s. He's co-host of the Baby Boomer Investing Show, which you see online. Ron has been a long time and very vocal and very respected critic of the way target date funds are constructed. Now, target date funds have become the safe harbor, is the real term of the art, default in many 401k plans. That is, if you don't choose, they'll put you into a target date plan. And Ron is fond of saying these are far more risky, especially as you get closer to retirement than most people think. And in fact, he's even patented an alternative, sort of a safe landing glide path. I'll let him get to that. But Ron, the real question is, let's start from the basics. What's a target date fund in a 401k? And then how did it become so popular that there's $4 trillion worth of assets in 401k plans that are using these target date funds? We need target dates 101.
Sure. So a target date fund is a fund that is um, tries to go for growth early on in the life of the participant. So it's fairly aggressive for young people. Then as your retirement date gets closer, it moves to become more conservative. That design had been used in college savings plans for a long time, but it got popularized in 401k plans with the passage of the Pension Protection Act of 2006. And that act developed certain qualified default investment alternatives. One of those was a target date fund.
Hmm.
So that's what really set target date funds on the map. It's become the most popular qualified default. And the notion of moving to protect as you need the money is solid. But where I've been criticizing the industry is that they're not safe enough. And let me just come to the point. Most target, by the way, the target date fund industry is an oligopoly. 70% of that $4 trillion is managed by Fidelity, Vanguard, and T. Rowe Price.
Wow, I didn't know that.
It's
Wow.
amazing.
Okay.
So most of the other players in the target date fund space are Me Too funds.
Huh.
And they're all pretty much in line with what Fidelity, T. Rowe, and Vanguard are doing.
Okay.
And they are at the target date,
Hmm.
55% in equities, which, that might be okay. But they're using long-term bonds as a safe asset. So another 35% long-term bonds. In my mind, that's 90% risky.
Yeah.
Now, the last 16 years have favored that allocation.
Why are they using long-term bonds instead of intermediate-term bonds?
I have no ideas. I mean, my guess would be you get paid more for long-term bonds, but it is what it is.
And in fact, some people retired in 2025. They have their money in the 2025 target date fund, and they're still sitting there. Now, you just said, I mean, people think we have to do 101 again. People think, well, stocks are risky, but it's a good thing they're in bonds because bonds are so safe. Now let's talk about why that's risky to have people in long-term bonds. About the year 2022, was it, when both stocks and bonds fell double-digit
Both went down. And Ron, also,
Yes.
the fact is these are marketed as set it and forget it. It'll take care of itself. But you're kind of pointing out, as Terry's alluding to, the risks inherent with those bonds.
Well, this is just a little sidebar for all of you who are going, wait a second, I don't understand what the risk is. All right, let's just say your target date fund, let's say you're going to retire in 5 years. You're in the 2030 target date fund. And let's just say that we know you need growth over the long run while you're retired because you're not going to die at 67 the way our grandparents did. You're going to live into your 90s. So, okay, they've got 50% in stocks. You accept that. And then you look at your target date fund and say, and gosh, it's 40% in safe, AAA rated, long-term, maybe it's even US government bonds. What could be wrong with that? Well, remember, when interest rates go up, bond prices fall. Doesn't mean default, doesn't mean going bankrupt. But in fact, as interest rates go up, the market value of
your
that
bonds
30-year bond goes down a lot.
Right.
So
Exactly.
when you look at the bottom line,
Right.
and let's just say interest rates go up, that's horrible, let's say, for the stock market. Now the stock market's down 20%. And your bond portfolio, because rates went up, even though they were US government
Has
bonds,
gone down.
it happened in 2008. And it happened in 2022. We had a crisis where interest rates went up and stock prices went down.
Mhm.
And now here we are in 2025 with people talking about the value of the dollar and interest rates and inflation and tariffs, whatever it is. You could see again the stock market go down, interest rates go up, and you would lose money on both stocks and bonds. Now let me turn it back to you, Ron, and
Sure.
explain what is the typical allocation in the 2030 funds that you take a look at. These are for people about 5 years from retirement. What are you seeing?
Well, again, it's about 55% in equities, 35% long-term bonds, and the balance in short-term bonds. Now,
Okay. So Ron, guys, the message is pretty clear. Glide path does not necessarily equal safe path.
A
Rich,
safe landing.
Rich,
Yeah.
yeah, Richard, I know you have some deeper questions.
Yeah, well, I think I saw a study that Morningstar did recently where they looked at how target dates have done over the years, and I think they said that they've had an average return of about 7%. I guess I feel like that's a pretty good return for people over the long term. And we're always talking about diversification. The target date funds have diversification, stocks and bonds. Now they don't have, I think what you've been doing, Ron, is including commodities and real estate. So
Yeah.
what would you like to see the target date funds own that they're not owning?
Well, let me point to the research that the target date funds say they're using. And this is really mind-boggling. So every one of them says that they follow this academic theory that integrates human capital with financial capital. They all say that. And the idea is as you age, your human capital is being depleted and it's being replaced with financial capital. So you need to rely on that financial capital more and more, which means you need to protect it because it's becoming more and more dear. A corollary to that is this notion of sequence of return risk. And retirement researchers have very much documented that if you're one of the unlucky ones, and so far for the last 16 years, nobody's been unlucky, but if you're one of the unlucky ones that happens to lose money as you're about to retire, that can dramatically affect the rest of your life. And that's called sequence of return. So the academic theory is clear. It first came out in 2007 by Ibsen Associates. And then last year, Morningstar published this, I have to laugh at this. It's like 50 pages of formulas. So if you were to read it, it's going to make your hair hurt. But the conclusion was the same. And now we need a drum roll. Academics at the target date, by the way, in the academic literature, that is the day that you're going to retire. You're going to hang up your guns. You're not going to get a salary anymore. No more paychecks. You're done. 80% in risk-free assets. 80% in risk-free assets.
Who
Very,
says that?
very safe.
Wait, who says that you should be 80%? I love that. Chicken money, you mean. But
This
who
is just your
says
chicken money.
that
So
I'm a
Ibsen
mistake?
Associates wrote the first study in 2007. There was Roger Ibsen, Moshe
Yep, the great.
Milevsky, two of their colleagues whose names aren't coming to me right now. The article last year was Paul Kaplan and
Mm.
Thomas Dorick. And again, both came to the same conclusion. So the underlying thing there, by the way, target date funds were first in college savings plans. And they are also very, very safe when the student is about to draw on the money. So the departure happened moving from the application for college savings to the application for retirement
Over the
savings.
course of retirement, yeah.
Yeah.
So, Ron, what do you tell somebody who says, I just want to do the right thing? I don't know a lot about investing. I don't really want to learn a lot about investing. I don't want to spend a lot of time doing it. I just want to make smart choices. And I feel like the target date fund is an easy way for me to do it. What do you tell that person? What should they be doing?
What they are doing is maybe not what they should be doing. And that I think that's the critical thing. That's just my opinion. But the quote answer for making decisions for you who want to do the right thing, you don't want to waste your money, you want to make sure you're getting a decent return on your investments and everything, you will default. Then that decision almost always, well, first of all, your employer will then make that decision for you. So when you ask the question, you say to your employer, I don't know, please help me. The employer's going to choose one of three qualified default investment alternatives. That is most likely going to be a target date fund. And then you're going to be in this thing that I'm concerned about. So you're trusting, and you probably should. Your employer probably loves you, but you, I'm the stuff I've written, it basically tries to reach out to these people and say, you need to look. And I'm not the only one who's saying this, and it's not happening. And I don't, so I've written a book and it's called Fisting Target Date Funds, but I'm not going to release it until the market crashes because I don't think you will look. You probably don't look very often anyway at your account balance, but when you do, and you've lost 30, 40, 50%, then you're going to look.
So it sounds like what you're saying is you're telling employees you have to take the time and effort and look at your investment choices and make decisions and don't leave it to the employer to do it for you. Is that right?
Yes, I'm saying that, and I'm saying it's unfortunate that it's like that now. It needs to change, but it is what it is.
Okay.
Yeah,
I
fair
I
enough.
understand the reason behind it. I think a lot of people aren't up to doing it and don't want to do it.
I
So
agree.
I
I
think
agree
we're
that,
in
yeah,
a tough spot right now.
that's exactly right. That no,
All
the
right.
guy who's running the punch press isn't gonna want to learn about investing. Now, again, this is for people who have defaulted. They're not making decisions. You're trying to make decisions on their behalf. And many of those people keep their money in the plan after they retire. So it's important to have some sort of design for people who stay in the plan. That design spoke, first of all, to protecting against sequence of return risk. So you need to start retirement sort of safe because there is that risk. You don't want to lose your money, as you're just starting retirement. But should be a drum roll here. The optimal is to re-risk in retirement. And there's no glide path other than mine that does that. It's a U-shaped glide path. And in the jargon of the industry, it's called a two fund if you're most safe at the target date. And it's called a through fund if you're not. This is both a two and a through. It's the lowest equity allocation at the target date, and it serves people through to retirement, through to
What
death.
is that, Ron? What's that allocation again for stocks? And when we say equities, we're talking about stocks, money in stocks.
Yeah.
What is the lowest point there to still get you the growth? Because none of us are investing in the stock market because we think it's fun to watch money go up and
No,
down.
right, right.
That's just
Yeah.
because we need the growth of the stock market. So how little, how much is the minimum allocation
So
for
in
stocks?
my design is 30%, but I do want to interject here.
30%. Okay.
Yeah.
Okay.
But I'm not alone. I just want
Okay.
you to know. Okay.
Okay. So my next question is, should pre-retirees consider reallocating right now, even in the midst of, there's been so much market uncertainty?
Yes. So among the things that I've written, I've screamed at baby boomers. You're probably in a plan that's more risk than you need to be taking now. You're probably not looking,
Hmm.
which is the key problem. They're not looking. But if you're reading my stuff, please protect yourself, and then, do that for at least the next 5 to 10 years. To do the chicken money. It makes all the sense in the world. But I do want to say, no, I'm a little guy. I don't have, well, anyway, I'm not alone. The Federal Thrift Savings Plan, the largest savings plan in the world, is 70% in the government guaranteed fund, the G fund, at the target date. Very, very safe.
TSP fund. Yeah.
TSP, yep,
Mhm.
70% safe.
So if you
Very, very
think people
safe.
if they should have 30% in stocks,
Uh-huh.
where should the other 70% be?
In the case of the TSP, it's in the government guaranteed G fund.
No, I mean for the general public. For our audience right now, they're in their 50s or 60s. They want to follow your advice.
Mhm.
They've heard you say don't have more than 30% in stocks at this point when you're in your 50s and 60s. Where should the other 70% be?
I think in treasury bills and short to intermediate term treasury inflation protective securities tips. Those are safe. I've written some other things about it may be that stocks and bonds are someplace you don't want to be in at all. And then there's other things you can do. I don't want to diverge off of the idea of the glide path for now, though.
Yeah.
So,
Right. Let's just wait a minute. Now let me just bring us back to square one here. Richard, you use 50s and 60s, but a lot of people aren't. Let's just say that someone's going to retire at 65 to 67, 67 being Social Security's current full retirement age. At what point? Now, if you told me you knew that the market was going to take a dive here, I would tomorrow. I mean, the minute after you told me and before it
yeah,
happened, I would go
if I
sell,
if I
whatever.
told you, I would. If I knew, I would tell you.
Yeah,
But yeah,
exactly.
sure.
So let's just talk to people now who are, let's divide this up. And let's start with people 63 to 65, 66. I mean, retirement is on the horizon. By retirement, we mean not so much
Yeah.
that you're going to withdraw,
Older than
but that
50.
this is the end
Yeah.
of the contributions.
Yeah.
So you're in a target fund and you take a look inside your target fund. It's the 2030 fund, let's call it, maybe. Okay. And you see it is what, 60% in stocks, 55% in stocks, and also 40, 35, 40% in bonds.
Right.
What do you do? It's your 401k. You don't have a lot of other choices in your 401k. You can't say, well, I'll just take some and put it in a money market fund, because inside the 401k plan, most people don't have a money market choice. Maybe they have a stable value. What do you do if you're in it, retirement's coming, and you believe you're scared?
Yeah. Well, first of all, you need to look. That's the key. But once you know, you should be concerned. And the 401k plan, I think there's a mandate to have at least three asset classes: safe, bonds, and equities. So you do have a safe alternative. I think that's a requirement for the plan sponsor. So
So you can say, I like my target date fund, but it's a little aggressive for me now that I'm close to retirement. And since I have most of my 401k in that target 2030 fund, I'm going to just make a switch. No taxes. You're still inside your 401k, and use the stable value fund or the very short-term government fund.
Exactly.
Okay.
Now,
And
I'll just add to that if you've defaulted, so once you do what you just said, Terry, you're not defaulted anymore. You've taken that away. And I work with Jack Twarnicki. He's on the ERISA Advisory Council. And Jack is really pushing for getting this out in front of the participant, even the defaulted participant, and trying to move them off of defaulting so that they can take more control of their destiny.
it's almost like you're saying, okay, wake up now. We've been telling
Exactly. Yes.
Listen, we've been telling y'all for years, don't look, don't look. Well, wait a minute. You got to look, you got to rebalance. Now we're saying, look, take a look.
You own it, whether you look or
Right.
not.
And
You
you
own
know,
it.
Ron, those three choices, I always call them like chocolate, vanilla, and strawberry.
There you
You
go.
know, and
Yeah.
then you're going to get from chocolate to more vanilla, vanilla, vanilla. Okay, let's shift gears just for a second and really focus on the now, because I think, you know, we're not so much focused on what people in their 50s need to be doing as much as maybe people getting really close to retirement. So now you're retiring. It's rollover time. What happens to that 401k? Terry, I know you've talked about the retirement
This is
rollover
big.
realities.
Okay, look, people just retire and leave it there. It's worked so far. Yeah, it's worked so far because, as Ron pointed out, we've had a 16-year bull market, essentially, and it's always
Been
gone up.
wonderful. Yeah.
Okay. Now you can't do anything. I mean, you're only stuck with the investment choices inside your 401k plan when you're working there. But the minute you're retired, you have this option. It scares people, which is why they don't do it. It's to do a direct rollover. Don't take the money out. Don't deal with taxes. You're going to roll over, just for safety's sake, to Fidelity, Vanguard, T. Rowe Price, or Schwab. And if you call them at their 1-800 numbers and say, I just retired and I have $587,000 in my company 401k plan, they'll say, oh, we'll roll out the red carpet for you. Now, first thing you need to know is you need to do it directly. Don't forget this thing about taking a check and reinvesting. Second thing you need to know is there'll be no tax if you do the rollover. Third thing to know is they're rolling cash. Forget about what funds or what target date you had. You get the chance to start over. So this becomes critical. Now you've rolled over $567,000 to T. Rowe Price or Fidelity or Schwab or whatever. And then someone says to you, how are you going to invest it? Your first answer should be, just put it in the government cash reserves money market fund for the moment.
Parking space.
Okay, it's there. And now you are a really big target. Pam, you talk about who's targeting you. First, they're going to offer, would you like some advice? Well, we don't really give advice, but we have advisors we could connect you with that use Fidelity funds or Vanguard funds. Yeah, they use the more expensive funds that have the higher fees, that some may have back end. They use all kinds of classes that are very expensive, or we'll just charge you 1% of your, wait a minute, 1%? When I could say, you know what, I'll put 40% in the government cash reserves, 15% in a short-term government bond fund, 15% in an equity income fund, and the rest in the S&P 500 fund. I'm not a genius, but I'll have some growth and a lot of safety. This is the critical moment when you do the rollover. Pam, talk about who comes after you
We've talked about that before in another episode. It's so true that this is the moment, the golden moment, where what you just said, Terry, about taking that money and what I call put it in a parking space, put it in a safe parking space and slow down. There's a lot going on. There's a lot of moving pieces. You are going to get pitched. You're going to have people coming from your 401k plan, the record keepers, the folks who have been tending to the plan, and they're going to all of a sudden come around with recommendations for your rollover. Just put it in a parking space. Don't do anything. You know how they say after something big happens in life, don't make any big decisions? This is a big thing in life. Don't make any big decisions. Park it, keep it safe, take a breather, take a moment. This is the moment, and Ron, I think you agree with this. This is the moment to get educated, not scared into doing something, just informed, because you have built this savings over your entire career. So your number one job right now is to protect that savings. And if you're married and you've got two 401ks and your spouse is about to retire or has retired, you have to think about how all of this is going
Yeah,
to
sure.
work for both of you and see the entire picture, not just part of it. I promise you, when you start hearing all these product pitches about, well, here's what we recommend. You're at the point of rollover. You're signing your stuff right now. This is the time for us to talk to you about what to do with it. No, it's not. That's the time to not do that. It's the time to
Amen.
park it. And and then when you're ready, get an independent, unbiased, fee-only advisor, sit down and look at the whole picture. Ron, I don't know if you agree with that, but
Oh, I
that's
do. Sure.
what I
Yeah,
say.
makes a lot of sense. I think we're all pretty much on the same page. But I will say this, the target date fund industry is not. It's on a different page.
I want to ask you another target date question, Ron.
Sure.
So let's say I've done what you said. I've looked at my target date fund to see where it's invested, and I'm unpleasantly surprised that it's in heavier in stocks than I thought it would be and that I want it to be. And so maybe my target date fund is a 2035 or 2030 fund. Is there much point for me to switch to a different date and go to a target date fund of 2025, 2026, 2027? Would I find a smaller percentage in stocks by doing that? Is that a good idea?
Yeah, no, again, I think where we're drifting here, and it's real easy to do that. Once you do that, you're not defaulted anymore. So yeah, if you think it's too risky, you can move from the 2030 to the 2020 fund, and that should be lower risk. But something very akin to that is going on right now that let me just touch on briefly. The industry has come to market with what is called a personalized target date account. And no surprise, they've come to market offering that as a qualified default investment alternative. Now, that cannot work for people who will not talk to you.
What is a personalized target date fund? What does that mean?
So it basically what they're saying is we're going to use the record keeper data, and for every person on your that you employ, we're going to make a personalized investment risk decision for them. And what's underlying that is basically a family of glide paths. And they say, so we're going to put you on the low risk glide path because blah, 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 whatever it is, using record keeper data. But the fact of the matter is that the record keeper data for most people is at like the last 3 or 4 years because people don't stay with it.
And PS,
Yeah.
record keeper data, that's a fancy way of saying all of your personal information about how you've been investing, how you've been defaulting, what you've been putting in, what you've been taking out, all of that.
Yeah. But you don't know the total wealth of that individual. That's the key thing.
No, you don't
And
know
then
about the assets outside that plan.
exactly, that's the point. And further to that point, if the idea is to take more risk for rich people because they can afford it, rich people don't default. So
Default means
it's
default. Well, let's just say that we've used the word a bunch of times. Default meaning we just send our money in, take the deduction, and put it where you think into the default option, which is the target date plan. The minute you say, wait a minute, I see you're taking $612 out of every paycheck. You can only put $312 in the target date. And I wish you would take the other 300 and put it in the short term or the stable value fund. Now you're no longer, quote,
Then you're not defaulted
defaulted.
anymore. That's
Okay,
Right.
right.
So
that's
it's
what I,
almost like you're saying, you do it for me, you do it for me. And then you push
Exactly.
back and go, no,
Yeah.
no, no, I want to do it myself. You're going that
Perfect.
back and forth. Yeah.
So coming back to the personalization, personalization works for the people who do want to engage. So about a third of the assets, about a third of that $4 trillion is from self-directed people. And I think if you put the steering wheel in their hands, they will love it. So this personalization idea has legs, but it's mostly for the people who do want to take control of their own lives. So they can say, I've had a life event, things have changed, I got rich, I want to take more risk, or I want to take low risk. I don't want to retire at 65, I want to retire at 85. They control all those variables, and that's perfect. So the idea of personalization, I think, is good, but not as it's being sold. It's being sold as doing it on behalf of people where they don't know. They don't have any input from those people. All they know is what's on the record keeper platform. So that's
So,
going on. You're going to see it. You're going to see personalization coming into 401k plans.
so what would you tell somebody who says, Ron, I understand everything you're saying, but I don't want to spend a lot of time managing my 401k. I don't really understand it very well, and I don't really want to learn a lot about it. I just want to know that I'm doing the right thing over the long term. So are you saying, so don't put any money into a target date fund? What do you tell that person who says, I don't want to do it myself. I want somebody to make their choices who knows more than I do, but I don't want to do it wrong either.
Okay, so
And wait, I got to follow on to that, to tack right on to the end of that. Should these be gradual, sort of changes, or do you do it all at once?
and when your employers make that decision for you, and they really do, they are well intentioned. There's no doubt about that. So when this whole thing started with target date funds, most of the decisions went to the bundled service providers. And no surprise, that's Fidelity, T. Rowe, and Vanguard. Then it became procedurally prudent to use those bundled service providers because that's where most of the assets are. So the fund companies are selling product that the employers trusted those fund companies to do what was right. They assumed that when they said to them, we're following this academic theory that integrates human capital with financial capital, that was actually going on. So I think there's been a big misunderstanding there. I know employers really do want to do what's best. And I'll even interject one thing here. There's been a hidden success story that most people aren't aware of. There's this group called RPEG, Retirement Plan Advisory Group, that has attracted about $50 billion into what's called their flex paths. I think it's important to know that the last time we got a shock in 2008, target date funds were only $200 billion, and our current baby boomers were not near retirement. So they really didn't feel that shock. Today, 78 million baby boomers, most of them are in what retirement researchers call the risk zone. And not $200 billion, but $4 trillion is at risk. So it's really become much more important. And again, the last 16 years have been incredible. And you only get to go through this risk zone once. So I might be wrong, and you might move to protect, and you might say that damn Surz, I missed it. I missed it because the market went up. But if I'm right, you're going to be very, very happy. And
Yeah,
I'm not forecasting a crash. I'm just
right,
saying if and when it happens, you need to be out of the way because you can't
right.
afford to be at risk right now.
Yep. Thank you, because this is the moment where instead of always saying, don't look, we're saying all of us here today are saying,
Yeah.
look, take a look. All right. Well, this is definitely the time to know what you own. Don't completely outsource your retirement peace of mind to some one size fits all target date fund.
Totally.
We're all encouraging you to log into your 401ks, and take a look under the hood for both yourself and your spouse. And know that we have our finger on the pulse when it comes to retirement plans. We're going to revisit some other aspects of what's happening with 401ks. For example, as the Roth rule changes in 401k plans. Once there's clarity on this latest tax bill, we'll do an episode that talks about the latest, the evolution of where 401k plans are going next and what they're offering. Thanks for joining us, Ron. This
Thank
is
you.
really, really insightful, great timing. And remember, you can check out our show notes at friendstalkmoney.org.
But we video this, so if you go to Friends Talk Money and want to see what we're wearing, you can look at the video version.
Okay.
Oh, thanks.
Thanks so much, Ron.
Yeah, thank you
Great.
guys.
Thanks,
Appreciate it.
Ron.
Friends Talk Money is funded in part by a grant from the Investor Protection Trust. The IPT is a nonprofit organization devoted to investor education. Since 1993, the IPT has worked with the states to provide the independent, objective investor education needed by all Americans to make informed investment decisions. Visit investorprotection.org. We also receive support from the North American Securities Administrators Association, known as NASA. It's the oldest international investor protection organization. NASA's members include state and provincial securities regulators from the U.S., Canada, and Mexico who serve on the front lines of investor protection. Recognizing that education and awareness are powerful tools in the fight against investment fraud, NASA is pleased to sponsor Friends Talk Money. Here are 3 important tips to help you protect your money from fraud. With investing, there are always risks, so be cautious of anybody telling you that a certain investment is guaranteed. You should also proceed with caution if somebody is promising very large investment returns. This is a common red flag for investment fraud. Last and most importantly, be sure you're working with a licensed or registered financial professional. You can check your advisor and make sure they're licensed by visiting brokercheck.finra.org. NASA is your partner in keeping you safe and helping you avoid investment frauds. Visit nasa.org and click on the Investor Education tab to learn more.